Bismillah ar-Rahman ar-Rahim. Wassalatu wassalamu ala Rasulillah. Assalamu alaikum. And we want to welcome all of you, all our distinguished experts, participants, and chief guests, and also all the people who have joined in from Zoom and also from YouTube. This is a tremendous occasion to get together. We are all getting together digitally right now. Perhaps we're more efficient that way to discuss the effect of the COVID-19 pandemic on the global investment outlook. There are going to be a lot of interesting presentations and talks, and then we will have a Q&A session, which would be moderated, and you can post your questions and answers in the Q&A tab. If you're following on Zoom, you can do that, and if you're following on YouTube, you'll be able to do that on the comment section as well. We have a distinguished set of panels also, which I'll introduce in due course. Firstly, I'd like to invite our chief guest of honor, the CEO of the ISIC, the Islamic Development Bank Entity Group, Chief Guest Osama Kaisi, to give us the opening remarks, and then we will begin our proceedings with the welcoming remarks from the DG Global Practice, Amadou Diallo, and we'll straight go into the items as such. So without any further ado, we will hand over the floor to Mr. Osama Kaisi. The floor is yours.
Brother Sayed, ladies and gentlemen, colleagues, it is with great pleasure that I join you today for this important discussion on the impact of COVID-19 pandemic on the global investment outlook. I take this opportunity as well to thank the United Nations Conference on Trade and Development and the Islamic Development Bank for organizing this important webinar. As you are aware, we are brought together today under unprecedented circumstances. The COVID-19 pandemic has created a devastating global health crisis, leaving no country, government, business, or individual citizen spared from the ensuing economic and social repercussions. The need to implement lockdown procedures in many countries has resulted in supply chain and trade flow disruptions, further aggravated by many countries responding to the pandemic with a more protectionist approach to trade. The risks associated with trade and investment have also been heightened due to the COVID-19 pandemic. Because of the speed and severity of the pandemic, what would typically have unfolded over many years, you would agree with me, is instead taking place over just a few months. These developments have adversely impacted the appetite for risk across almost every industry. While we are witnessing the second wave of the pandemic, we are glad to know of the recent news that the global medical community is nearing the development and wide distribution of a vaccine. We need to ponder upon these developments and ask ourselves the following questions. What are the global political dynamics that will play and take shape in the distribution of the vaccine to the least developed countries? What does the low-risk appetite and protectionism mean for the many countries that are highly dependent on exports and foreign direct investments? According to UNCTAD's 2020 World Investment Report, the global flows of foreign direct investment will be under acute pressure this year as a direct result of the pandemic, essentially reversing the already lackluster growth in international investment across the past decade. Flows to developing countries, many of which being IDB members, are expected to take the hardest hit, as export-oriented and commodity-linked investments are among the most serious affected by the repercussions of the pandemic. In order to combat these implications in our member countries, ISDB and its group members, ITFC, ICD, and ISIC, have implemented a number of initiatives to maintain trade and investment flows. The overall COVID-19 response program for IDB Group is composed of 3 stages: respond, restore, and restart, covering member countries' needs in the short, medium, and long terms, respectively. Respond as R1 proposes immediate dispersing actions to assist member countries in acting quickly to mitigate the adverse impact of COVID-19, Restore, as R2, addresses medium-term actions to strengthen health infrastructure and economic systems to overcome the pandemic's peak. And lastly, Restart, as R3, supports long-term actions to kickstart economies on a solid and resilient foundation and to catalyze private investments. As an initial response, IsDB Group committed 2.3 billion US dollars in funding to the Strategic Response Preparedness Facility, including initial contribution under R1 response of US 345 million for ISEC insurance solutions. The facility has been essential to IDB OIC member countries' efforts in fighting the pandemic and addressing the negative effects on economies, being utilized to secure urgent medical supplies and essential imports for member countries. ISDB and ISEC have recently as well concluded the framework agreement of US $2 billion COVID-19 guarantee facility, which is an innovative program designed to support the private sector in the medium term. Looking towards long-term recovery, ISDB Group is calling for enhanced South-South cooperation and highlighting the benefits of sustainable Islamic finance solution. ISEC will be a significant part of the long-term recovery, supporting the increased demand for risk mitigation solutions. Further to these response efforts and more directly relating to investment support, ISDB Group is an active partner of its member countries' investment promotion agencies, working closely with them in efforts to counteract the effects of the pandemic and attract crucial investments. However, you would agree with me that IPAs are also struggling to redesign their strategies and policies to combat uncertainties and attract new investments. There is still much work to be done to ensure our member countries are supported through these troubling times. With that said, I am pleased to note that ISDB is partnering with UNCTAD on this timely webinar to spark a conversation that will continue at the 7th Annual World Investment Forum, hosted by member country being the United Arab Emirates and brought together under the auspices of UNCTAD. The 7th World Investment Forum starts in less than 3 weeks with the theme of investing in sustainable development. I look forward to hearing today with you on the impact of COVID-19 pandemic is having on direct investment and trade in ISDB member countries, and perhaps most importantly, look toward the hearing about the suggested policies and strategies at ISDB and the whole group, including the private sector entities, can explore to revitalize investments and trade in our member countries. I am honored and glad to open today's session and look forward to joining you in hearing the valuable insights of an experienced group of industry leaders that is joining us today. Thank you.
Thank you very much, Mr. Kaisi, for your words and your words of wisdom, and also setting up the stage. I really appreciate it. And here I'd like to invite the Director General of the Global Practices of Islamic Development Bank, Amadou Diallo Diallo, to give the welcome address to all the participants, and then we will proceed with our panel discussions. So over to you, Amadou Diallo.
Hello, can you hear me?
Yes, we can hear you now.
Yeah, thank you very much, Brother Said. Mr. Osama Kaisi, distinguished speakers, panelists, and participants, ladies and gentlemen. Assalamu alaikum and a very good morning, afternoon, and evening to you all. On behalf of the Islamic Development Bank, I would like to welcome you all at this very timely webinar on the impact of COVID-19 pandemic on the global investment outlook. I would also like to express my gratitude to the United Nations Conference on Trade and Development and two IDB entities, the Islamic Corporation for the Insurance of Investment and Export Credit, ISEC, and Islamic Corporation for the Development of Private Sector, ICD, for participating in this webinar. It gives me great pleasure to welcome James Zahn to the IDB Group to share UNCTAD valuable knowledge in their seminal work, World Investment Report 2020. This year's report prepared by UNCTAD under the background of COVID-19 has made its analysis more revelatory than ever. James and his unit have been a friend of the bank for quite some time now, with numerous joint program and activities that we conduct year after year. I would also like to take this opportunity to commend the IDB strategic and fruitful partnership with UNCTAD. This relation has a well-established track record and is often held up as a model in the investment promotion circles. Indeed, since 2014, both institutions have been implementing a joint project to build the capacity of an international investment agreement IIA negotiator from member countries of the IDB Group to equip them with the necessary policy tools and knowledge to effectively engage in the reform and modernization of their old generation IIAs. This project has so far trained over 300 negotiators and policymakers from IDB member countries, mainly from the least developed nation. Ladies and gentlemen, we all know that the current COVID-19 pandemic has generated an unprecedented global health and economic crisis. As it's caused worrying effect of human life, it also significantly slowed down the global economy through disruption in production, global supply chain and trade, leading to substantial investment drop. You will hear today how global FDI flows were down by 49% in the first half of 2020, with developed economies experienced the biggest fall and developing economies also saw a 16% decline. Though countries have been responding proactively through various fiscal and monetary measures to mitigate the health and economic constraints, renewed challenges persist. As we get together today, global growth prospects remain weak, rising financing costs of investment, eroding confidence and increasing uncertainty with further deterioration of pandemic and investment situation. The member countries of Islamic Development Bank have been confronting difficult challenges as well. OIC CESRIC forecasts that the GDP of ISDB member countries will contract by 2.0% in 2020, average per capita income by 3.4%, with significant deterioration in the current account balance and fiscal sustainability. FDI to ISDB countries is predicted to fall sharply due to their natural resource and tourist-oriented investment profiles and continued logistical and supply chain constraint. Ladies and gentlemen, in the fight against the pandemic and addressing the negative effect on economies of member countries, ISDB Group has committed a total of 2.3 billion funding package under its strategic preparedness and response package that was highlighted by Mr. Casey. ID Group is utilizing innovative tools and offering product to help member countries in mobilizing external resources and accessing cheap, short and medium-term financing for the benefit of the private sector. IDB also offers investment promotion and capacity development to IPAs to stimulate investment in member countries. This webinar is expected to spell out the update of global FDI, especially in the light of the COVID-19 pandemic and its impact on investment and trade, in addition to policy suggestion for reviving production structure despite the pandemic. Finally, the discussion will particularly focus on strategies needed to boost investment in IDB Group member countries, and in this regard, will provide practical guidance to investment promotion agencies and member countries. I would like to thank you all once again for your active participation in this webinar. It's a great pleasure for me and IDB to be associated with this important knowledge session. Thank you all.
Thank you very much, DG Amadou. We really appreciate that. So now we'll go into the heart of our webinar. We'll start with our keynote panelist, James Zhang. James is not just a friend of the IDB who's worked significantly with each other. James is also the Senior Director of Investment and Enterprise Division at UNCTAD. He leads the UN World Investment Report, which we're going to be talking about very shortly, and is the Editor-in-Chief of Transnational Corporations Journal. He also chairs the governing board of the UN Sustainable Stock Exchange Initiatives, which have members from all the major stock exchanges worldwide. He brings a plethora of experience and expertise on this particular subject. So we all look forward to hearing him give the overview of the findings of the report and overall findings that UNCTAD has recently made. So over to you, James, and off you. Thank you.
Okay. Thank you very much, Mr. Saeed Hossein. Mr. Casey, Mr. Diallo, first of and distinguished participants, ladies, gentlemen. First of all, on behalf of UNCTAD, I wish to express our gratitude to you for inviting my colleagues, Hamid, Akadi, and me to participate in this important seminar. And also, I wish to take this opportunity to express UNCTAD's gratitude to IsDB for close collaboration and excellent partnership over the past years, including in the context of the World Investment Forum. Indeed, our partnership has been fruitful and impactful. So we are very grateful to that, and also to the leadership of IsDB. Today, for my presentation, I wish to focus on two aspects that relates to global investment, particularly during and beyond the pandemic, the global crisis. First, the short-term prospects and the longer-term prospects, and followed by the challenges, opportunities, and the strategies. I think Mr. Casey and Mr. Diallo already highlighted the response of IsDB and their thinking. So here I just wish to share with you the global perspective on that. Let me start with this chart. It shows the prospects, the short-term prospects of global FDI as a result of the impact of COVID-19. And you can see the consequences of that. In fact, the pandemic is a triple shock of supply, demand, and policy. And it has a severe impact on not only investment, but also trade and global value chains. For the outlook of the global economy over the next 2 years, that remains highly uncertain, and that you have heard of the impact on global GDP from IMF, World Bank, OECD. So roughly that global GDP will fall by 4.5% to 5% this year, and before growing by 5% next year. And in terms of trade, you may have learned that the WTO already forecasted that global trade declined by 9.2%. That's their expectations for this year for merchandise trade, and more seriously of trade in services. And that could be a kind of 7% of a rise next year. So this is the GDP and the trade forecast according to our sister organizations. Now, regarding the investment, according to our UNCTAD forecast, because we have the authority, we are perceived to be the authoritative source on international investment. And for that, according to our estimates, global FDI flows will likely decrease by up to 40% of this year. And this is from kind of $1.5 trillion of last year. So this will bring kind of the FDI, global FDI, below $1 trillion for the first time since 2005. So that's the drastic decline, and you can see from this graph. The global FDI is projected to decline by a further 5 to 10% in 2021, next year. A gradual rebound of global FDI would probably start in 2022. And this would show a kind of U-shape of recovery, U-shape of recovery. And this is unlike the forecast of global GDP and trade, as I mentioned earlier, that they will expect a kind of a V-shape of recovery already starting next year. So for FDI, it's lagging behind. This is normal according to the nature of the investment cycle compared with the global business cycle. And then that's why FDI is hit harder by the global pandemic. So overall, the outlook for global investment as well as trade and the GDP are highly uncertain. The prospects also depend on the duration of the global crisis and the effectiveness of the policy response. And furthermore, the geopolitical conflicts, the financial risks, and the trade tensions will add more uncertainty. So in fact, the world is entering into a kind of era of VUCA. VUCA meaning volatility, uncertainty, complexity, and ambiguity. And that creates kind of longer term challenges for international investment and multinational enterprises in their international operations. So the impact is severe everywhere, but it varies by region. FDI flows to developing economies are projected to decrease more than developed economies, and transition economies are expected to see the biggest fall. For those countries that rely more on investment in GVC intensive and extractive industries, and these industries have been severely hit. I think Mr. Diallo and Mr. Casey already alluded to in the case of the members of IsDB. For the time being, we just released the data on the first half of this year. And for the first half of the year, global FDI declined by half. So this is more than what we projected for the whole year. For the first half of the year, it declined by 47%. But interestingly, developed economies suffered the most, and they suffered kind of over 70% of decline of FDI flows is mainly because of a few advanced countries like Switzerland and Netherlands that they suffered from a huge negative inflows in FDI for the first half of the year. Developing countries as a group weathered the storm relatively well. For the first half of the year, it suffered only from 16% of decline on average. Latin America and Africa suffered more, while Asia suffered less, roughly about 12% for Asia and the Pacific. So that's why, as a whole, developing countries weathered the storm well for the first half of the year. But we need to bear in mind of two factors. First, that a large number of developing countries suffered from the pandemic relatively late than the advanced countries. That is one factor. The second factor is that if you look at kind of developing countries depend more on greenfield investment, and these greenfield investment are coming in stages. If we look at the data on the greenfield investment announced projects for the first half of the year of developing countries, I'm talking about the newly established, newly announced deals, the number of the deals and the value of the deals, developing countries suffered for close to half of the reduction. So meaning the forecast of this greenfield investment in the second half of the year will kick in because the greenfield investment announced deals are the indicators for the near future of investment flows. So our forecast I said earlier about the whole year that developing countries will suffer a lot is based on that. So it remains valid. Now, I've been talking about this pessimistic forecast, the picture, but we need to see the positive aspect. The positive aspect is that despite the drastic decline in global FDI flows during the crisis, the international production system with FDI stock at $37 trillion today will continue to play an important role in economic growth and development. For example, the share of global FDI stock of the global GDP is over 40%, over 40%. It means FDI plays an important role in the economic growth. Take developing countries, for example, also, that the share of the FDI stock in developing countries over their GDP is also over 30%. It's roughly 33%. And this is because of 11 trillion US dollars of FDI stock, meaning investment already in the country in operation in terms of factories, establishment for services, they are already there. So we need to see the positive side of it, and then to ensure not only to promote investment, new investment, but also to retain investment, to facilitate investment in the middle of the pandemic and immediately after. So this is the kind of prospects that I can share with you regarding the short-term prospect of this year and the year after. The global FDI recovery is expected to start in 2022. And as you see from our graph, that such a recovery won't be a kind of very steep recovery. So there's still a challenge of how to promote and stimulate investment for sustainable recovery in developing economies. At this stage, we do not envisage that global FDI flows will recover to the level of 2029 fairly soon, as you can see from the current graph. But there is a need for policies and for strategies regarding to that. Now let me turn to the longer term global investment trade prospect, that in the framework of global value chain or integrated international production networks. As we see through our World Investment Report, over the past 30 years, international production saw 2 decades of rapid growth, followed by one of stagnation. And in 2010s, I'm talking about the past decade, the cross-border investment in physical productive assets stopped growing, and the growth of trade slowed down, and the GVC trade declined. So please move to the next step, next slide. The next one. The next one, I'm just trying to escape. No, sorry, let's go back to this one, yes. And in fact, the global, the growth of trade also slowed down, and global value chain trade also declined. Global value chain means intermediaries goods trade, that as inputs to the total exports of final products. So the past decade, in fact, was only the quiet before the storm. The crisis caused by the COVID-19 pandemic arrives on top of the existing challenges or pre-existing challenges, such as the international production system that is rising from the new industrial revolution, sustainability imperatives, and growing economic nationalism. So with these triple challenges, on top of that, we have the pandemic that has the disruptive effects on global value chain. All these 4 factors that really tipped the point, and in fact, the pandemic sets to the tip of the scales, and we see today. So we believe that the decade towards 2030 is likely to be a decade of transformation for international production and global value chain. And this will reshape the global trade and investment. And I'm going to explain how it will be done in that way. In our World Investment Report, we established a new analytical framework. We look at how the triple drivers, that is sustainability imperative, rising protectionism, that change that will realign global governance as well as the new industrial revolution, technology revolution. And they all, based on that, we'll see how global value chain will be transformed in 3 dimensions: the length of the value chain, the distribution of the investment in the value chain, and the value added locations. And then we do that through 4 trajectories. That is reshoring or nearshoring, regionalization, diversification, replication, and these 4 trajectories. And then we looked at across 5 industry groups. It's grouped according to their level of globalization or internationalization. So, for example, we look at extractive industry and agribusiness processing as one group, as a location bound, and then we look at the GVC intensive manufacturing. There are 2 types of that: high technology intensity and a mid-low technology intensity. So that's the second group. And then we looked at multi-domestic manufacturing. Typically, the industries that are located in market customary proximity, and normally they have a global hub and a spoke, such as a kind of food industry like Nestle, or pharmaceutical industry like hub and spoke. So that's the third group of industries. And then we look at the fourth category, which is the group of services. So there are also 2 categories: kind of low value added services, such as wholesale, retail, trade, transportation, logistics, and concentrate high value added services, such as financial services, business services. And then through the 4 trajectories, as I mentioned earlier: reshoring, diversification, regionalization, replication, interacting with the different factors, the 3 mega drivers, and then we arrive at a kind of a general conclusion of this transformation of global value chain, which will reshape the future pattern of global FDI and international production system. The first is that let's move to turn to the another slide to move on. This is, I talked already about the trajectories. Now this one, the key implications of transformation. The first will envisage in the next 10 years, there'll be evolution of kind of a shorter value chains and the less fragmented value chains. So the value chains will become shorter for manufacturing. That's partly because driven by the new industrial revolution, partly because of the rising protectionism and the regionalization. Secondly, we will see that the more concentrated value added, that is in countries, more concentrated in a sense, we'll see a lot of the transformation from mass production to mass customization, driven by, again, technology, particularly the technology related to 3D printing, so that additive manufacturing will kick in. Therefore, you have many locations for manufacturing instead of a kind of long chain across the borders. The third direction that global value chain transformation will be a kind of a more platform-driven and asset-light value chain governance. As you may know that in the past, there are many value chains of different industries. Normally, they are led by multinational companies. We call the lead firms. And these lead firms in auto industry or in electronics, in garments. So you have one big company coordinating the production in different locations for that. And then recently, this role gradually shifted to the kind of technology ICT companies. So it's now more of a platform-driven, platform-based, or IT platform kind of coordinated global value chain and international production. So you see, even for the top multinational companies, there are more and more multinational companies as from the ICT sectors. And because of that, because of the nature that services, e-services and e-commerce plus the platforms can be cross-border without heavy investment. Therefore, you see that there will be a kind of foreign footprint light or asset light kind of way of investing abroad, or that managing the global value chain and supply chains. The fourth trends or implications is a shift from global to regional and sub-regional value chains. This is what we see driven by, number one, the resilience and the diversification of risks by multinational companies. So they want to go for near shore, and they want to have multiple locations rather than to locate in one region, or that across regions because of the transportation cost. There's the sustainability dimension into it, and there's also a kind of geopolitical risks that are driven. So this is kind of from global to regional and to sub-regional is another phenomenon. The fifth is a kind of, as a result of all these transformation global value chain in terms of global FDI, so there could be a downward pressure on global efficiency-seeking FDI, but it's in favor of a regional market-seeking FDI. That's what you can see from my explanation earlier. The seventh trend will be a shift in some industries from large-scale investment to smaller-scale distributed manufacturing. As I mentioned earlier, because of the mass customization and the customs proximity requirement for the modern industries enabled by distributed manufacturing technologies and the digitalization of value chains. The eighth trend is the continued growth and fragmentation of service value chains. The service value chain will grow further, and we expect bigger offshoring of services, in particular what we call white-collar jobs, and including high-value added services, with the exception of the services related to data because of the protection of countries and the privacy laws of different countries. So there will be a slow process of liberalization in cross-border data flow related services, and that we don't see a big offshoring. For the rest, we see a lot of possibilities, and the pandemic has shown that the digital economy plays a key role in global value chain. The ninth trend is the kind of is what we envisage, a kind of multinationals will start diversification of products, services, and the value chain locations, and it's driven by resilience and also driven by national security concerns. So they try to avoid a reliance of critical inputs from foreign sources. So that's why there will be a pressure for multinationals to diversify their value chain and to have wider distribution their value-added segments. And the last trend is the trend of shift from GVC investment, cross-border investment in infrastructure and the domestic services, and there will be a shift of investment more into the green and the blue economies. That's driven by sustainability imperatives, particularly the Sustainable Development Goals. So countries are having the endeavor to promote investment in SDGs by putting in place incentives, other measures with the support of international organizations and impact investments, so on and so forth. So what are the policy implications? For us, we see there's a need to move towards a new global value chain development path. Please show the next slide. So there will be a kind of shift of the development strategies in light of the challenges and opportunities. The challenges, just to try to highlight the four that we see. The first is the increase of divestment, relocations, and investment diversions from some developing countries, particularly in East and Southeast Asia, will have a kind, and also kind of the shrinking pool of efficiency-seeking investment that implies tougher competition for FDI. The second is the value capture in the global value chain development paths based on vertical specialization will become more difficult. And the third challenge is that industrial infrastructure that built over the past years for a world of global value chain will see diminishing returns. So many countries have built such kind of large infrastructure to achieve the scale of economy on very narrowly defined segment of the long global value chain in order to export, to be the supplier of global value chain. And that will get difficult. And there will be a kind of diminishing returns. The fourth main challenge is the change in locational determinants of investment. And this will often negatively affect the chances of developing economies to attract M&E operations. And in particular, that's related to rising of protectionism and also the drive for made from home by some advanced countries. And that will push for some reshoring, if not possible, and then nearshoring. And that will have some implications for some developing countries that's suffering from mature kind of industrialization. Now, with the challenges, there are also opportunities, and opportunities also ample. The first is the attracting investors, that countries can attract investors looking for diversified supply bases and building redundancies and resilience. I think that provides the opportunities to Latin America, to some African countries, and in the case of Islamic countries, the Gulf region, Gulf Council region, they also have some opportunities for them. The second is the pool of regional market-seeking investment will possibly increase. That's also linked to the regionalization and diversification. And the third opportunity is that as value chains become shorter, and this will bring more investment in distributed manufacturing in smaller scale and to produce the final goods production, and that will benefit those countries that have kind of industrial capacity building and clustering in their locations. And the fourth opportunity relates to the digital infrastructure and platforms. And this building's investment in this area will enable new applications and services and improve the bottom-up access to global value chains. Now, confronting the challenges and capturing the opportunities requires a change in investment development paths. So there should be a shift from the focus on export-oriented efficiency-seeking investment in narrowly specified GVC segment, as many countries did in the past, to an broader export-based investment in production and productive capacity building for regional market, or that focus on a kind of broader industrial base. So building productive capacity at home and to clustering at home and to have a broader based industry for manufacturing to prepare for the next 10 years is very important. Secondly, there should be a shift from kind of cost-based competition for single location investors to a competition for diversified investment based on flexibility and resilience. That is what companies, multinationals are going to do on the eve of the recovery and moving forward in the 2020s. And the third shift is to shift from kind of prioritizing large-scale industry investors with big infrastructure to make room for smaller scale manufacturing facilities and services that with lean infrastructure. Finally, there's a need to shift the investment promotion strategies towards infrastructure and the public services. And this is necessary. And over the past 3 decades, we see that many developing countries are more focusing on efficiency-seeking FDI cost and attracting investment in resources and low-cost labor. And these will remain important, but the pool of such investment is shrinking. Therefore, we need for diversification. We need to build a kind of clustering at regional, sub-regional, and country levels for export. So there should also be a degree of balance towards a kind of attracting investment into the green and blue economies. There are huge opportunities in the blue and green economies. We see a lot of money in this area ready to invest in green and blue. Just give you example that sustainability themed funds has reached $1.4 trillion last year, according to our World Investment Report, and it was kind of 260 billion green fund US dollars of green bonds, 900 billion of sustainable equity funds ready to invest in, including impact investment, and also kind of over 100 billion social bonds that are ready to invest, particularly in the health sector. For example, for the first 4 months of this year, the social bond in response to the COVID-19 reached 55 billion US dollars for the first 4 months, and this is larger than the whole year of 2019. That shows the rapid growth. Therefore, attracting investment in green and blue and in SDG sectors are critically important and will be very effective. With this, I would say that UNCTAD will be in close collaboration with developing countries, including through the partnership with IsDB in the future, to focusing on this transformation and shifting of investment development strategies to formulate a new generation of investment promotion programs and to attract the investment for sustainable development and SDG sectors in particular. So I wish to thank the IsDB and colleagues for the future partnership. Unfortunately, that I have to leave in a few minutes for another session I booked for 1 hour. But my colleagues, senior colleague Hamid Kadi is with us. He has been our interlocutor, our organization's coordinator with IsDB, and then he will be ready to step in to answer questions and to make the closing remarks. Thank you very much for your attention.
Thank you very much, Mr. James. We really appreciate your very informative presentation, and we take note of course being digitally available for seminars and webinars means that you have them all back to back as well. It was a terrific overview of the global environment, and you also identified very, very pertinently the opportunities and challenges. And just for the benefit of the audience here as well, I just wanted to comment on the fact that the Islamic Development Bank has a global value chain based business model and approach. And we've also had to sort of rework in terms of how do we ensure that these GVCs are more resilient, they're more responsive to the situation, and they've also identified exactly they're a little bit more localized and more dense value-added activities going on, as exactly what you just mentioned. So I'm glad that we have concurrence of experiences both from quantitative and qualitative perspectives as well. And I think some of those areas would be also touched upon by our next speaker, Mohammed Bukhari, He's the Senior Investment Promotion and Regional Cooperation Specialist at our Department of Country Strategy and Cooperation. Has had more than 20 years of experience and track record in investment promotion, marketing, administration, project management, conducting technical assistance and training to IPAs. So all the audience members coming in from various different IPAs, Mohammed Bukhari is one of our experts into this. So designing innovative investment promotion, technical assistance programs, and other projects, he's really been at the forefront. And a small team of him and Mohammed Ghulam Murtaza have also been working in coming up with a new report, which Bukhari will be talking about. So without any further ado, I'd like to give the floor and invite Mohammed Bukhari to give his presentation on some of the findings that we have collected at our level at the Islamic Development Bank. So over to you, Mr. Mohammed Bukhari.
Thank you, Brother Said. Yes, can I share this? Yeah, share my presentation. Thank you, Brother Said, colleagues, ladies and gentlemen. It is both a pleasure and honor for me to be here and to speak in this seminar. As Brother Said said, I mean, in the introduction that my presentation is an outcome of a paper prepared by the Country Strategy Department by Brother Ghulam Murtaza and myself. This is part of the paper which will be available in the IDB website, I mean, shortly after this seminar.
Sure. Can you please put it on the presentation mode?
Yeah, sure.
Thank you.
Sure, Brother Said. It's okay?
Yes, perfect. Well,
okay. As the background and context, the COVID-19 pandemic, as we all know, has triggered an unprecedented global health and economic crisis. Besides its worrying effects on human life, production, global supply chain, and trade. This has also been, it has also disrupted, I mean, investments and trade. The FDI has been declining, and according to UNCTAD's investment trend monitor, the global FDI flows in the first half of 2020 were down by 49% compared to 2019. While developed economies saw the biggest fall of 75%, developing economies experienced 16% decline. In the inclusive response measures, countries have taken a wide range of measures such as fiscal stimulus packages, business cash flow supports, and relaxed measures, relaxed tax measures. These all, I mean, emergency measures are driving countries to refocus their regular investments. There are plenty of opportunities for reviving investment, especially in sectors focusing on emergency supplies and economic resilience, and opportunities for reorientation in the global supply chain. Investment promotion agencies need to respond quickly and decisively in supporting the already distressed health sector and businesses for stabilizing their operations, and also for tapping new opportunities, including attracting investments to their territories. With regard to the IDB strategy during the COVID-19, the IDB has acted very swiftly to support the member countries financially and technically by approving 2.3 billion strategic preparedness and response program. The SPRP program takes a holistic three-track approach, which we call 3R. Respond in the short term, and restores in the medium term, and restart in the long term. The three tracks are designed to assist member countries' efforts in preventing, containing, mitigating, and recovering from the impact of the COVID-19 pandemic. Supporting trade and investment has been always very critical part of the IDB support program through trade, financing, investment insurance, and capacity building activities undertaken by our private sector entities, ITFC and ISIC. IDB also has put in place innovative tools and product offerings to mobilize external resources through a COVID-19 guarantee facility fund to scale up the total financing capacity of the bank for investments in member countries. Also, the IDB has also allowed member countries, governments to access cheaper short and medium-term financing for the benefit of the private sector. In the promotion of investment and capacity development of investment promotion agencies, the IDB has been working with partners to organize investment conferences and seminars to stimulate investment in member countries and offer capacity development programs to investment promotion agencies. And this part of the partners we have been working with are UNCTAD and WIBA, ICDT, and AIM Dubai. The impact on IDB member countries, as of 11 November 2020, there are 5.3 million confirmed cases of COVID-19 in the 57 IDB member countries. And there have been 129,742 mortalities, and 4.4 million were treated successfully. CESRIC, in its report, a 2020 report, estimate that the OIC countries are expected to contract by 2% in 2020, and to grow, at 5.4% in 2020 if the global economic situation is improved. I mean, also they are forecasting that the average per capita income level in the group of OIC countries is expected to fall by 3.4%. Most OIC countries, according to CISRIC's report, are expected to face significant deterioration in their current account balances, as many OIC countries rely on remittances, and remittances are affected severely by the COVID-19. The way forward to attract investment for the IBAS on the strategic level, doing business in our IDB member countries is relatively more difficult when compared with other categories of countries. At the regional level, the performance of the member countries differ remarkably and needs a lot of capacity building. So investment promotion agencies in the IDB needs to work in improving the business environment. Also, there is a need for upgrading transport infrastructures and skills. The IDB member countries need to develop adequate transport infrastructures and multimodal transport corridors and networks to improve the infrastructure and skills deficiencies in order to reduce the costs of the trade and to enhance export and investment competitiveness. Also, there is a need to promote intra-OIC trade and investments, and also to adopting regional and global value chains, because that should develop, identifying regional complementarities and substitute industries. So developing a collaborative regional value chain will generate new comparative advantages, accelerate strategic diversification of products and services, and create new economic dynamics among the IDB member countries. In the way forward to attract investments in IDB member countries, we need to revive the domestic investment by extending necessary credit flow, preferably at low costs, and also to support the SMEs and agriculture. IDB member countries need to expand support to SMEs, credit and agriculture, for saving large numbers of jobs and for ensuring basic food security. Also, there is a need for promoting private investors in public sector initiatives. There is a need for creating basic public investment choices, and there is a need for prioritization of capital spending. Adjustments to member countries' capital spending programs are greatly needed through developing and maintaining pipelines of projects that are technically well defined. There is a need of rationalization of current expenditure. A number of member countries may need to rationalize their current expenditure significantly through cutting down discretionary spending, such as physical training, various kinds of repairing and purchasing, and utilizing the online facilities. Also, there's a need for using technology for business operations and support, in addition to retaining in the way forward to attract investments in the immediate and short term. There is a need for retaining investments through intensifying aftercare and providing policy advice. IBAs need to focus on investment facilitation and aftercare measures, including this is for the investment retention, and also needs to apply, further measures, to help foreign investors throughout the crisis by providing information, timely, and by facilitating post-pandemic trade and investment opportunities, and providing comprehensive information to client by identifying also benefits from global supply chain change and reshaping strategies accordingly. The IBAS needs to consider long-term consequences of distributed global value chains, which may break down the existing supply chain and also create opportunities within that trajectory. Also, there is a need for utilizing technology for emergencies and economic resilience. Investors may generate and sensitize the ideas of using technology for massive data accumulation, analysis, and reserve for extending reliable safety net programs and subsidies, and providing telehealth services, training, medical education, and administrative meeting, telemedicine, and e-medical record systems. As a recommendation for the IDB Group, the report, goes to these 5 points, which we think are very important. and needs to be addressed to assist member countries be able in a better shape, to attract inward investments. The first one is helping member countries to enhance the business environment to attract FDI by policy reform and institutional strengthening and hard infrastructure upgradation. Also promoting regional cooperation and integration, RCI strategies for generating comparative advantages by operationalizing an IDB's RCI strategy through advocacy, financial assistance, and capacity building. Also, number 3 is to catalyze domestic investment for emergencies and economic restoration by public investment for emergencies and economic recovery, liquidity of financing and PPP opportunities for private enterprises. Number 4, promoting technology adoption through digitization, health emergencies, education services, including remote learning and business services and e-commerce. Number 5, supporting investment promotion agencies of member countries by providing information on new opportunities in economic recoveries and support for institutional strengths. By this, I'm coming to the end of my presentation. Thank you for listening. Back to you, Brother Said.
Sure, thank you very much. That was a good coverage of from a regional perspective of actually different regions. We looked at Africa, Asia, Latin America, and all the different member country groupings of the Islamic Development Bank. They all have some shared and some unique features, which you really very well captured in your talk and presentation. So I've noticed that there are some questions with regards to regional and market integration, and we'll come back to it at that time, and we'll do that. So, but without further ado, I want to go to our last speaker of the day, Ashik Moeed. Ashik is the Division Head of Infrastructure and Corporate Finance at the Islamic Corporation for the Development of Private Sector, ICT. His talk will be going a little bit further down and drilling down into the private sector and the local environment and local market players as well. Ashik has been involved for more than 2 decades in financing private sector projects in emerging markets. So all our audience members, particularly from the emerging markets, would find a lot of useful information coming in. He's been leading the ICD finance operations since August 2018. ICD's infrastructure and corporate finance team deals with the financing transaction in a lot of different sectors of infrastructure, power, renewable energy, industry, retail, etc., in the form of both project finance as well as corporate finance. So he brings in a wealth of experience and expertise again. And I, without any further ado, I'd like to give the floor to Ashik Moeed before we open up for question and answers. Thank you. Ashik, over to you, and you may share your screen.
Thank you. Sure. Can you hear me well?
Yes, we can.
Okay, I'll just put the screen on.
Yeah.
Thank you very much, Hussein. I'm Ashik Moeed. I head the infrastructure and corporate finance business of ICD. It's a real honor to be in this seminar with this distinguished audience and distinguished panel members. Before I start my presentation, very quickly, I wanted to thank the previous 2 panelists for their excellent and insightful presentations. As I move into my presentation, which is about how we can sort of boost investments in IsDB Group member countries, I think a good place to start is to stop for a moment and think, what are the basic drivers and motivations for international investors to venture into new markets and new countries? So these are really classified into 4 key drivers. And one driver is for them to gain access to large economies, fast-growing markets. The other driver is to gain access to technologies and human capabilities. The second one applies more to what we see in OECD countries because of the advancement they have on technologies and human capital. The natural resources is another major attraction for a lot of international investors to venture into countries and gain access. We see that quite a lot in our member countries. And the last one is basically low wage efficiency and so on. And as Mrs. Zhang correctly pointed out, it has kind of plateaued a decade back, and it's under a lot of pressure. From our own experience, what we see is there are a few buckets of areas that really makes things easy for investors, be it international investor or be it local investor. I would single out the governance and institutional capacity as the biggest factor, along with the economic stability. These two things are really, really important. International investors or even domestic large investors are always well equipped with top-notch lawyers, top-notch technical consultants, great executives, and it doesn't really help if the government-facing institutions are not correspondingly well equipped, and that's the challenge that we have all the time. And then the infrastructure readiness, what we see is a same project, the same power plant cost twice as much and sometimes even more in a challenging country, maybe a country in sub-Saharan Africa, as it might cost in, let's say, GCC. And that's mainly because there are a lot of additional infrastructure that needs to be built in. So those things really hugely affect the lead time of the project construction, the project development, as well as the ultimate cost and the challenges for the EPC contractors or any investor for that matter. Financial market, really important for kickstarting a lot of small, medium investments. The domestic financial markets, both banking and capital markets, are very important. International lenders and investors are very, very interested about large investments. But when it comes to medium, small, it becomes more and more challenging, and those needs to be addressed locally. And then finally, regulation and human capital. These are really very important. In a lot of our countries, regulation is challenging in terms of foreign ownership as a percentage, how much you can own, borrowing foreign loans. Those things are not always very easy. Creation of collateral is not always very easy. So what are the general indexes and rankings available in the marketplace? So one thing we do look at with quite a bit of interest is the World Bank Doing Business Index. No index is perfect, but it does a decent job in a lot of respect. And what they do is they look at few practical items as listed on the left-hand side of the presentation. As you can see, like how easy or difficult it is to start a business, how easy or difficult it is to get construction permits and stuff like that, getting electricity, registering property, getting credit, paying taxes, trading cross-border is a big one, enforcing contract and so on. Now, based on all these parameters, they try to rank 190 countries. And when we look at those rankings, the 2020 ranking, what we notice is some of our member countries are actually doing very, very well. Countries like Malaysia and UAE are amongst the top 25. And then we've got some of the other countries that are also doing fairly decent, like Turkey and others who are in top 50. And then we've got some other countries doing modestly well, which includes Saudi Arabia, Kuwait, and so on. And we've got about 23% of our member countries in that 51 to 100th rank countries in terms of ease of doing business. But then we've got 36% of our member countries who are ranked in the bottom 40. And that's not a nice thing. So I think there's a lot of room for improvement in that bucket. And we've got another 31% that are ranked between 101 and 150th country in terms of how easy or difficult it is to do business. Now, if we look at the big economies in our membership, so when I say big, we put a random threshold of $200 billion based on EIU estimate for 2020. So these are all estimated nominal GDP in US dollars as estimated for 2020 by EIU. And we superimpose their doing business rankings, so that's on the right-hand side. So what we see is that, as I mentioned, the few countries are doing fairly well, fairly decent, but then you've got some member countries who are still trying to improve and gradually improving. And what's the size of those countries that are ranked below over 100, so in the bottom 90? So you're talking about quite a few countries and more than 2 trillion plus economies just within the top few countries in terms of economy size. So there is a lot of work that can be done, should be done in order to make it easy for all sorts of investors, and there should be quite a bit of headroom for attracting investments by improving the business climate. Some of our member countries, on the brighter side, some of our member countries really did well last year in terms of improving. In fact, 7 out of the top 10 most improved countries globally were IsDB Group member countries. You've got countries like Saudi Arabia, our host country, jumped 30 places and moved from 92 to 62, which was an amazing achievement. Bahrain did very well, Jordan, Pakistan, Togo, Tajikistan, Kuwait. All these countries were amongst the top 10 most improved countries in terms of improving the business climate. So that's a phenomenal achievement by the IsDB Group member countries last year. Now, how much did the market get affected by COVID? So my favorite topic has always been infrastructure. So I picked up infrastructure as a random sample. So if you look at the infrastructure deal value, and these deal values represent new investment as well as refinancing as well as acquisition. So it's not necessarily new investment, but it's a good proxy. So if you look at that, in general, what you'll see is that it's dropped quite a lot between Q3 2019 and Q3 2020. You see this counterintuitive spike in Q2 2020. That's mainly because people rushed to close deals. People saw the tsunami of economic turbulence coming, people rushed to close deals, and that reflected on the second quarter. In terms of MENA, where the volume literally dropped by 1/3, the huge spike in Q2 this year is really 2 transactions. One is an Aramco acquisition of Saudi, $70 million, $69 billion in fact, and another acquisition of 49% share by a consortium of investors for ADNOC's gas pipeline. So that's about 80, and then there was another financing for 10 million. So that's pretty much it. So overall, you see 20 to 50% decline between Q3 last year versus Q3 this year. So a huge drop, especially in sub-Saharan Africa. If you look at the sub-Saharan Africa, it's like 52% drop year on year. Now, there is some good news as well. Like if somebody is making investment, it's an absolutely awesome time to borrow money. Cost of funds have never been lower. If you look at this orange rings, right now on the right-hand side, we're below 1% in terms of 10-year US dollar mid-swap rate. So we took 10-year rate as a proxy because it's long-term investment. We go back a few years, 10 years, it was close to 4%. We go back further, it was close to 6%. 30 years ago, it was more than 8%. So now it's phenomenally low. So borrowing is very cheap. That helps a lot of investors. In terms of opportunities within our membership, I think Mr. Zhang also rightly pointed out on the popularity and attraction of the green economy and the green infrastructure. We have a fairly busy traffic of renewable energy deals. And we do get a lot of opportunities in that. And I think a lot of our member countries can basically take the lead and not invest so much on conventional and directly move to renewable in a lot of cases. So power and renewable remains a very interesting space for all investors. And the electrification rate and the per capita consumption is very, very low in a lot of IDB member countries. So there is a lot of upside. Infrastructure, same extractive sector, energy is always going to be very important and a big attraction in our member countries for foreign investors. But the additional item will be the value addition and beneficiation and so on. Petrochemicals, the same thing. Agriculture is becoming increasingly more important and popular. Financial sector, again, a huge side. We are seeing a lot of traffic on social infrastructure, but mostly domestic investors. So by that I mean hospital projects and so on. So that has become very popular. Places like Indonesia with the government mandated health insurance, and in places like Saudi Arabia, where there's been a lot of regulatory change on the healthcare sector to cover private sector employees as well. under the employer-provided healthcare insurance. So those have really pushed the market upward. And services, I think this is something Mrs. Wang also talked about. There's a lot of opportunities there. And the other thing we're coming across on a practical note is a lot of South-South investments. Like major investors within our region and even mid-sized investors are reaching out to other member countries for investment opportunities. We financed a solar plant in Egypt, sponsored by a Saudi sponsor. And then everybody, in terms of globally celebrated name, you see Mubadala and Master as one of the major international investors along with PIF. In fact, UAE last year was one of the top 10 international investors in terms of FDI outflow. So there's a lot of liquidity and a lot of movement of capital also as potential. So with that, let me stop here, and it was a great opportunity, and thank you very much.
Thank you very much, Ashik. I think we continued with the theme of identifying the challenges, but also at the same time noticing the fact that crisis leads to opportunities, and what are those opportunities? I think all our speakers, presenters, everyone touched upon them, whether it was at a global macro level, regional, and then individual country levels. And you also gave a good performance update in terms of how different countries are coming along. And infrastructure seems to be, digital infrastructure particularly also, seems to be a common unifying theme about these elements. So there's been a very good, robust discussion that has already taken place in the chat box as well. I can see that lots of questions have been asked both at Zoom and on YouTube, and we'll get to that. If it's all right with the rest of our presenters, maybe we can stick around for another 10-15 minutes more, and we address at least some of the most pressing questions that have been raised. So, and there were some other elements as well that we noticed that we captured while the presenters were going. So if we have Hamid with us, Hamid, one of the things that we noticed in the report was the fact that the global FDI inflows declined significantly this year. But this decline was very disproportionate between developing and developed countries. The drop was nearly 75% in the developed countries, whereas in the developing countries, surprisingly, it was lower. What are the basic reasons behind this variance? Is it sort of a delayed reaction, or is it a data issue, or where would you put that up to? So over to you, Hamid.
Thank you very much, Syed. Yes, I mean, we have been, we saw in the past, I think, 5 or 10 years that every time there is a shock in terms of a global crisis that has an impact on FDI, surprisingly, it's developed countries that take the immediate shock. That's because basically investors, the home country of investors is mostly located in developed countries, the big investors. So in terms of reflecting the numbers in the World Investment Report, as you said, the immediate shock is taken by developed countries in terms of on paper, the reporting on the FDI outflows and inflows. But we will see this, the impact maybe next year or in 2 years' time. There will be, we will then see the impact of the crisis today on FDI flows in developing countries. So what you said about delayed reaction is true. We also have to remember that developing countries rely mostly on FDI in natural resources, raw material, etc. So they are more resilient to crisis of that nature, because when you are looking for natural resources, I mean, we have seen investors going after natural resources even in times of war and civil war. Investments, resource-seeking investment is very resilient, and so whether this is a good or bad thing, we will see. So I hope I have answered your question shortly in order to allow maybe for other questions from participants.
We really appreciate that, because we do have tons of questions. I'd like to invite my colleague Mohammed Ghulam to sort of just give us a flavor of some of the questions he's been picking up on the chat box at Zoom and on YouTube, and the questions he had received earlier. So, Ghulam, if you're with us, could you just give us a flavor of some of the important questions coming along? I noticed there were questions on regional integration, RCEP, and others on IPAs as well. But over to you, Ghulam, if you are connected with us. You are still muted, Ghulam, I think.
Okay. Yes. Thank you, Brother Said, for the opportunity. And some common questions coming about how can countries and organizations.
It's louder, but I'm not able to hear you very well. Sorry.
Some of the questions are coming about the support from ISDB, how countries and institutions can access ISDB support. One actually common approach is that whenever you want to get the ISDB support, you may contact with our regional hub through the appropriate country authorities, because your idea and your projects should be by the respective governments. And you can see the hub address in ISDB website. It is there. On some of the one of the questions was like African support to African countries. So ISDB, there are many countries from Africa actually who are already member of ISDB, and ISDB has been providing its supports through country strategies over the years, and will continue to do so in coming days, especially helping the countries to be engaged with global value chain, and the whole ISDB country strategy approach in future will be based on the idea that how can ISDB help its member countries through engaging themselves into global value chain. ISDB also has been providing supports to Muslim countries, Muslim communities of non-member countries. So if anyone from the non-member countries, but ISDB is always ready to support the Muslim community also. So these are the questions actually I wanted to respond. Thank you very much.
Okay, thank you very much. I think there was a question on Africa, specifically African countries, what should be their approach and FTA-related matters. So I can invite Hamid to actually probably have a first go, and then Bukhari can come in and sort of also say that what sort of support is are you looking at providing to the IPAs and other agencies over there. So first to Hamid, I guess, and then to Bukhari.
Thank you very much, Syed. In UNCTAD, we have been supporting the African Union in our division on investment, especially with regards to the investment protocol, which is not yet concluded. Maybe this is not something that people talk about a lot, but we have the African Continental FTA, which has been signed, ratified, but we have the investment protocol, and this belongs to phase 2 of the African investment agreement, the African Continental FTA. And so we have been supporting the African Union and other investment stakeholders in Africa in providing technical assistance and capacity building, specific formulation for provisions that aim at ensuring investment protection within Africa, so intra-African investment protection, while maintaining the right of African states to regulate in the public interest. I think this balance is extremely important, and we are following closely these discussions of the investment protocol. I am told that formal negotiations for the investment protocol will start later this year, and so this will really be something that everyone who's interested in the African Continental FTA should look at. Thank you.
Thank you, Hamid. Same question to you, Bukhari. On what should be the different approach for African member countries on the CFTA and other items on the IPAs as well. So. you can unmute yourself.
Sorry, Brother Said, I cannot hear you well. There is a problem in the sound. There is echo.
So, okay, I apologize for that. I was asking a question on what should be the African approach to mitigate the effect of COVID-19 impact.
Okay. Thank you. Brother Said, thank you. I think the IDB has been providing technical assistance, programs, capacity building and programs in the areas that will assist investment promotion in member countries to be in a better position, to attract more flows of investments. Also, the IDB has worked, closely with international institutions like UNCTAD, WIBA, in building the capacity of negotiators, investment negotiators for the international investment agreements, for many, hundreds of negotiators from African member countries has been trained. The number of also officials, high officials of investment promotion in member countries that has been trained in investment promotion strategies and also in building institutional capacities, of a lot of investment promotion agencies in collaboration with our partners like the World Bank and WIBA. So we have been, always supportive to the investment promotion agencies and providing them with whatever we take. We are demand-driven program, Brother Said, and whenever we receive, program, we respond, request, we respond positively to that.
Sure. Thank you very much. Ashik, one of the questions that was coming in is that you gave a good overview of the countries that have recently performed well and why, but did you witness any sectoral variances in the different countries who have sort of stepped up and have better rankings right now? Or do they have unifying themes which are essentially a product of that sector winning out rather than the country doing something exceptional over there? So over to you to answer this one.
Sure. I think what's happening is this reforms that each country has taken. If you look at the scores of individual items, different parameters within the ranking, different country had challenges on different parameters. And so it's not necessarily a common theme cutting across all countries, but there are differences. But all these changes that has been made, the benefits of these changes are rather long-term. So I wouldn't say that this will unbundle investments right away. There is always a lag, but overall, I think in a way, when your investments and new businesses are relatively low, it's a wonderful time to sort of rectify some of the regulations and some of the structural issues. So I think that's what a lot of these countries have done, especially looking at the challenges in the hydrocarbon market, where the prices have really stayed quite depressed from late last year, as a matter of fact. And there's been a lot of motivation to push for essentially more liberalization of the economy in terms of structural reform. So I think those have been some of the main aspects, and they will help. Those actions will definitely help going forward on a wide range of sectors.
Sure, thank you very much. Hamid, one of the questions that was also coming in for you was that you identified shorter, more denser GVCs right now. Do you see this as sub-regional value chains as opportunities? But do you see this as a mitigating phenomena, or do you really think that there is some substance to the fact that this would be something that, at least for the next medium term, we would be witnessing this instead of the large multilateral global value chains as such?
I think there is a shift, as James presented. There is a shift from the global value chains to more regional ones, and I think that's something that we can see as a positive development, especially if we link it to some of the questions on RCEP, for example. We just discussed the African Continental FTA. We have the new NAFTA, or the new North American Free Trade Agreement. So there are important regional integration or regional FTAs, and I think that the investment geography or the investment map is going to change, and there will be a gradual restructuring towards giving more importance to the regional dimension of investment. And I don't think this is a bad news. I think this will emphasize the importance of regionalism, and hopefully that will be a building block towards a more global perspective on investment, but in the years to come after the crisis. So whenever you have a crisis, it's very normal that the reflex is to shrink either domestically, nationally, regionally, and then things go back to normal. But I think having a regional focus is much more healthy than completely focusing inwards and domestically and nationally, which is the risk of the crisis today. We actually are seeing some countries taking a protectionist turns in order to protect some of its sensitive industries, sectors, etc. So regionalism, I think, is a good news, good development in the context of today, and in the context of the crisis we are going through now.
Yes, thank you. That's pretty elaborate on that. Ashik, one of the terms that you mentioned, I believe it was you mentioned South-South investment. And would you want to sort of clarify and sort of expand for our audience, what did that exactly mean, and what are the potentials and opportunities coming in the private sector for South-South investments?
I mean, in terms of, thanks Hussein for that question, and that's one area that is becoming quite exciting. What we are seeing is that a lot of our member country investors have sufficient liquidity, especially investors from GCC. And there is a great interest to explore markets that are also within our membership. I gave you the example of the solar power plant that we financed in Egypt, which is really an investment from a Saudi entrepreneur. Similarly, we see GCC investors moving to places like Uzbekistan, moving to places like Indonesia. So we're now finding a lot of investments moving around within membership, and even outside membership. What we are seeing is that within, let's say, African continent, we have Africa-based funds making investment in yet another African real sector project. So we're observing that quite a lot. Recently, we had a series of renewable energy projects taking place in Tunisia, and a lot of the investors from MENA took huge interest to go and participate in those. So that's one area which is becoming increasingly more interesting. Right now, we are talking about an agriculture plus renewable energy project in one of the North African country, supported by other Middle Eastern investors. So we're observing that trend quite a lot nowadays, and I think it also relates to that regional value chain approach, where people are looking near home turf to find opportunities in many places.
Both in terms of their business, but also in terms of the capital as well. So thanks for that. I think there are tons and tons of questions, and we would not be able to do justice to them to sort of just respond in a couple of lines or sentences. We need to, one thing I realize is that we need to have a lot more engaging webinars as well, like this one, that has generated so much interest. And I think, Brother Bukhari, we've got our work cut out for us. There are lots of requests coming in for support on capacity building, facilitation, investment facilitation. The report as well, many people are asking about that. So I'm sure we would be able to take that on board and come to it. I do understand the time of our presenters is also very limited, and everyone has to sort of go ahead and complete the other items of assignments. So I really, really wanted to thank you all for your participation and your interest and your questions. I was wondering if there are any closing remarks. Anyone from our Director General, Amadou Tierno, if he's with us, wants to say anything. And I know, Hamid, you wanted to sort of have a word towards the end as well. So, Tierno, if you're with us, would you like to sort of offer any reflections? I'm not sure whether he's connected or not yet with us completely. Hamid, so we would like to sort of give you the last word in terms of any concluding remarks and anything that we should be looking forward to in the future as well.
Thank you very much, Said. I think this was an excellent, very timely webinar, and I think this only reinforces the existing successful cooperation and partnership between UNCTAD and the ISDB. I think, as Brother Bukhari and Brother Diallo and Brother Kaisi and yourself mentioned in the beginning of the webinar, that we have been cooperating for many years. We look forward really to strengthen this cooperation even further. And concretely speaking, we will have our World Investment Forum, which is our biggest gathering once every 2 years. The next one will be held in October 2021. It was postponed due to Corona in Abu Dhabi. And we look forward to a strong presence and partnership with you. We can have a side event specifically for the Islamic Development Bank. It would be our pleasure and honor to welcome all of you there. Another point that also came up in the questions is the question about technical assistance and capacity building. I think one thing we could do jointly as a response to the participants and to the ISDB member countries is to start looking at maybe the virtual means of having a technical assistance or capacity building workshop. I know the inconveniences, but I think we have postponed our annual international investment agreements workshop for this year, obviously during Corona, but we can explore jointly together if this is something agreeable to you. The idea and the call for strengthening cooperation and technical assistance, including through virtual means. So this is something we would like to look into. And once again, I mean, on behalf of all of UNCTAD, on behalf of James, we really value this cooperation. You all know that when we are asked in UNCTAD about our impact and reporting and to give us success stories or best practices, the first success story or best practices that comes to mind and goes to our monitoring and impact file is our cooperation with you. So thank you very much, and I look forward to continue this cooperation even in these difficult times. Thank you all. Thank you, Sayed, for your excellent moderation, and thank you everyone for this excellent meeting.
Thank you very much, Hamid. I mean, you really captured it all. And on behalf of the Islamic Development Bank, I can assure you that we will provide all the support and all the assistance and all the facilitation to work together, whether it is in the World Investment Conference and even in the other programs, digital ones that we've mentioned. We have Mohammed Bukhari, Mohammed Kamal, Afa, all of them who would be very happy to sort of set up these programs as we go along. And hopefully this will be very useful to all our audience members to be able to participate, not just in person, but also online as well. So this has been another opportunity that we've identified in this pandemic world, that how we can sort of bring lots of people together who otherwise would not have been able to. The only other items that I have to mention are two housekeeping items. One is the fact that we will immediately as we conclude, we will be sharing the survey. So we would really want to hear from you what worked well, what didn't work well, how do we improve our webinars in the future, and how do we, what different topics would you want us to sort of organize, and experts that you want to bring in, we can bring in jointly or even with other partners as well. The last thing I want to mention is that in organizing these type of events, there are lots of participants who are working behind the scenes to ensure that, for instance, today, more than 113 different countries were able to join in and register. More than 500 participants registered, and more than hundreds of them on Zoom and on YouTube as well. So that is a testament to the fact that there is a large audience which is sort of waiting for lots of these things. And it's also a testament to the great work some of our team has done. I really want to mention by name Hamid Al-Qadi, Sahad Marwai, who led the promotion activities, Faisal Saati, Azman Fattani, Ishraq Pasha, who was with us the entire time the last few days, Hassan Khalifa from ISIC's office, Afra Khalifa from our offices, Mohammed Kamal, Mohammed Ghulam Murtaza, and Bash Nabi Bash. I really want to thank you all for a terrific job well done, and this has been a really great experience from all of us. And again, stay safe, keep your family safe. The pandemic is not yet over. No matter how lax we can get, opportunities exist, crisis is also there. So just be careful, just be safe. Thank you very much once again, and Jazakallah khair. Assalamu alaikum wa rahmatullah.